welcome back. So now we're going to go over sort of a step 2 in this, where something happens and how do we take advantage of it. Again, this is not financial advice. If you're unsure about what you're doing, you're going to probably lose a lot of money. Don't do things that are highly leveraged. You're only going to have yourself to blame. So we're over here. We've entered our situation, and this is where we're at the price of the stock. Now, like I said, it could go one of either 3 ways. It can go a lot more in one way or the other. It can take longer to do one or the other, but it could really only do one of 3 things before we decide we're going to make our move. And that's going to be, it's going to go up, down, or stay kind of the same. So let's go over what we'd do if it went down. So it would move in this direction, and we'll find ourselves over here, let's say. Okay? So this will be our new spot. Now, what I would, if you are used to trading options, you kind of have a good idea of what happens here. This area right here gains money, and this area right here loses money. But the thing is that this area gains more than this area loses. And that's why we pick numbers that create this visually. Because you'll visually see that this is gaining a lot more than this is losing, as is shown in this graph, right? So that means that in this going up, this has gone up. So we've made gains on this. We've sold too much because the volatility goes up. So this actually, we start having like slight losses. But altogether, this is more gains than losses. This starts actually giving us some gains. And this gives us some losses. Okay? If this doesn't make sense, pause and think about it. But it should be pretty intuitive. Because it went in this direction, what you were long, inflated, and what was short against you, inflated, but you had sold it. Versus this deflated and you were short, so this now costs less, but you sold it at a higher price, so that's good. But then you bought this at a higher price, but then it went against you, so now this is down. Okay? And so, how do we best take advantage of this situation right now? If we're deciding right now is the time to make an adjustment, how do we do it? Well, like I said, this section right here now is inflated. And we already know, given our criteria, that this is a highly volatile stock, and we don't know whether or not it's going to go up or down in the long term anyway. So we might as well be appreciative and happy that we have some gains here. So let's extract that. But considering this is at a gain and this is at a loss, if we just simply close this, we're going to accrue some capital gains here. You can just as well open, instead of closing a position, you can open a position which removes some capital from this, but then you don't have to actually close this out. You can let it expire as long-term gains. The way you would do that is if these two options are far enough in price that there is a price in between or closer towards the long end, you'll close this. So you close this. You'll open another sold position, that's much closer to your long position. This again, if this doesn't make sense to you, pause it, think about it, do your simulated trades, see if it applies. Because what happens is you have this much you're long, this much you're short. You harvest a loss here, and because you sell a new position that's closer to the price, in fact the price of the stock too, especially, and this is a key point, during an event of high volatility, because like I said earlier, if it's made a big move, by definition volatility spiked up, right? So that means you're going to get a lot more for selling, at least selling in the direction that it headed. So if you closed this out, which would be at a loss because this got inflated, and so closing that's going to cost, it's going to accrue a loss, but then you sell even at a higher price, that gives you back capital, but it opens a new position, and you don't have to close this and that you made gains in. Now you can put this on steroids if you want, if you're a madman and you have the capital to do it. And we also know that this is a very bipolar price action type of stock. If this has lost more than 50% of its value, you could close it out. Does that make sense? So, what I mean by that is, it swung one way. We make our adjustment, where if it goes in the opposite direction now, whenever, because again, we bought ourselves a lot of time, we're going to make multiples of a gain in the opposite direction now, because all of the attention has been going in this direction, that people start like outbidding each other less on the opposite side, and they're more so chasing price over here. So if we instead of closing this, maybe we just open another call here, where we doubled our gains. We basically transform this type of a graph where it moved over here, and we take out our gains, granted, so that means we actually gain liquidity from this. We transform it into some crazy thing like that. Because think about it, we've already pulled, we can't gain anymore, and this end already lost its value a bit. So if it keeps going in one end, there's only, like, it might go a little bit down, but like this part that, like, it's losing value of it going down against it. At this moment, we decided we're making an adjustment. The part that of the capital we still have in there, it is already deflated in value. So I don't care as much if I lose it. In fact, that's why I'm saying if you're a madman, might as well double down on the opposite direction, where we create a situation where, like I said, our end result is we end up with a risk reward where if it goes against us, we'll lose 100% of, say, a small amount of money. But as soon as it goes in our favor, boom, huge rewards again. Granted, this is starting off from a profit. Now, if this made sense to you in it going down, it's actually very symmetrical in it going up. Same exact thing. I'll draw it out for you because I'm such a nice guy. But it'll be good review either way. So here we are again. Up and down means our profitability. Left and right is the price of the stock. We create this graph. And we do this having one long here, one short here. By having one long here and one short here. And now let's say it does this instead. Now what do we do? Well, the exact same thing in the opposite direction. We close this one out. So we open at the same time, take advantage of the volatility on this end. Over here, if we're crazy, close this out too. Or, I don't want to undo, but you get the idea. Instead of, like, pretend I didn't cross that out, it actually is still there, so P minus, but we'll just buy another one out here. Because it costs less, it's even further away from the price. We're not planning on waiting and holding these until expiration anyway. Most option traders, a huge majority of them, don't ever actually allow options to expire. They're all just sort of, if it were to, trading in and out. It's all speculation, right? But again, transforms this into, from here, from this, into insurance. Much steeper, by the way. I don't, this is not drawn to scale. There's no coin on this picture to give you a sense of scale and steepness, but if you did this, trust me, this is way steeper. And I can show some examples, although like I said, we were initially thinking of Coinbase here. I set up some simulations on MicroStrategy because it's also crypto related and highly volatile, highly catching some headlines, creates good volume, which is another point. I don't think I brought this up, but I like trading things that actually have a lot of people in the market because it reduces slippage. So if we're trading options, especially options that are far out into the future, you might not have a huge percentage of the people that are trading there with you. So you need something with high volume so that there's someone to trade with. If you're trading some obscure fund that only very niche people have heard of, you're probably not going to get someone to trade with you. But if it's Coinbase, where you're hearing everyone talking about Coinbase, it's going to be a lot of people trading, which means that you're not going to have to give up a good price to trade it in order for there to be someone there to trade with. And that's what's known as slippage. So there'll be someone to actually trade with at, like, the bid and the ask will be closer together is the main idea. Okay. The higher the volatility, the higher the volume, the closer the bid and ask typically are. Okay. So this might not help, but I'm going to try anyway. This is actually what it looks like on Thinkorswim. Obviously this is not a paid video, but this is how when I talk about the U shape, if you look at that purple line, that's what we're creating. That's the today line. You can see the date there if you're able to zoom in quite close enough, but the more of them you have, the steeper it is. And so, of course, if I zoom in, it's going to give you the appearance that it's a steeper, right? So, if let's say this is missing one side of the trade, so give me one moment. Let me add another simulated trade. So our first example was it went down. So let me set up a scenario where I decide to do the madman route. I'll make it disappear for now. So calls, let me even those out. Yeah, see. Okay. So let's say the center line is where we are. And just so you know, this theta value right here, this is how much it costs to hold this per day. So, I mean, you can't see the axis there, but each one of these lines is $1,000 of gains. If you consider that type of power, it costing you $17 a day to hold when it has a potential to swing thousands of dollars in either direction, I'd say that's a pretty good cost benefit. Not forever, because as you can see, the purple line expires into the blue line. So eventually, if it stayed here and we did nothing, this will just be worth nothing. But I'm not a day trader. I have things to do. So I can't just be sitting around just looking at charts all day. But when I log in and I see it moved in one way or another, I can take advantage and then get on with the rest of my day. That's the advantage here too. This is not day trading. That's why I like to buy long term. You know? So let's say, like I said, this moved over here. $2,000 in profit right there. It doesn't matter what the numbers are because you're gonna practice with whatever your portfolio is. And so if you figure out how to just consistently make a certain percentage, you're going to keep making that percentage of like a larger and larger amount, right? And you might as well learn your lessons and screw up with a smaller amount of money before you start, leveraging the damage. So we're over here now. Let's say suppose I close this section out. This is not even the tax optimal way. Let's say I closed some of these puts out. So it sold 7 now. So each one sold. As you can see, this is turning into the Nike swoosh. So let me zoom out. I haven't even closed all of them. And so now, look at this. This is what I mean by disproportionate risk reward. We've just adjusted our position. We've accrued a gain here. That's why it's below this line now, because I actually did actualize the gain, so that all that's left in the market right now is all losses. Because the stuff we gained, we closed, right? Does that make sense? So our adjustment here now, from here, is a much steeper incline towards the stuff that lost value. And if we want to put that on steroids, look how steep that is. That's if we closed all of them. Like I said, if you're a madman, you do this. But let's say we just did 1 out of the 10. That's 1/10. We have to zoom out. Look at this risk reward. It's exactly how I drew it out. If it goes against you, it goes against you. But notice how the more it goes against you, the less and less steep that incline gets. And the more it goes for you up here, the steeper it gets. Not only that, you're also going to get a volatility spike, so the whole thing's going to go up when you eventually sell and getting your capital back, and rinse and repeat to other things. But like I said, these strategies, you can't do this exact play on every stock, and if this is all you do on everything, you're going to basically, you can make good money doing that. I'm not about that life, because if everything I hold I'm doing this with, that means that everything I'm holding is every day losing money. But then the one day it decides to move, it moves in a disproportionately grand way, which makes up for all the smaller losses and then some. But this is way more powerful in the context of a portfolio that's also giving you theta, as in it's giving you time decay working for you, where the cash flow is actually positive. And so it allows you a budget to apply the specific scenario. And also it plays a great strategy for creating insurance, because if you can open up these situations where you have disproportionate gains towards the downsides, if you just flip this on to the opposite end, having a few of these open in case of a stock market crash can make up for all of the losses in your 401k holdings. So it's powerful stuff. So that's pretty much it. I don't think I have to go over. All right, there's one other thing. What do we do if it stays still and does nothing? So I guess I'll go over that in the next video. This one's already long enough. Thanks for watching. This is Passive Aggressive Money. And leave your questions and comments and whatnot down below. Take care.